Welcome and good afternoon, and thank you for joining us for the final session of day one of Future Forward Summit, generating your year-round tax revenue with niche services. My name is Gary D. Hart, and I'm the host for Future Forward Summit, host of Accounting Insiders podcast, and publisher of Insightful Accountant and Tax Practice News. Our speaker today is Paul Hamman. He's the founder and president of RC Reports. Paul is an expert on determining reasonable compensation for closely held business owners. He has educated more than 100,000 tax advisors and evaluators on the topic of reasonable compensation and has been published in numerous national and state journals. A couple of housekeeping items before I turn this over to Paul. This is a CPE eligible webinar. Just like any other CPE webinar, you need to answer at least 3 of the poll questions. We do have 4, but you need to answer at least 3. And you have to be in session for 50 minutes, 50 minutes. And we will process those certificates and get them out to you in email within 24 hours. Likely it'll be done tonight, but we give ourselves 24 hours. So if you have any questions, put them into the questions panel. The chat panel is disabled, so put them in the questions panel. And then once I turn this over to Paul, I will put a link to our YouTube channel, which is where the recording for this event will be posted. Usually takes about 4 or 5 days for that to get posted. But then I will also post a copy of the presentation in the chat panel for you as well. Both of those will also be sent to you as a follow-up email, as a follow-up to this entire event. And with that, I will turn this over to Paul. And Paul, thank you so much. Thanks for sharing your info here. I look forward to learning a little bit more about reasonable compensation because our accountant has been we had a meeting with them last week and he talked about reasonable comp. I'm like, well, I'll learn more, see if I can teach them something.
Perfect. Thanks for that introduction, Gary. And hello, everybody. As Gary mentioned, I'm Paul Hamman. I am one of the founders of RC Reports. My background, expertise, and knowledge is all based in and around how you determine reasonable compensation for closely held business owners. So let's take a quick look at just our agenda for today, what we're going to be talking about. I'm going to spend just a little bit of time on some background. What is reasonable compensation? How is it defined? And a little bit of time looking at the 3 different approaches that the IRS recognizes and uses on in their own internal job aids. Then we're going to take a look at why most S Corp owners would use something called the cost approach, and that is one of those 3 IRS accepted approaches. And since this is a whole program on the niches, we're going to explore a couple of different niches today in and around reasonable compensation in real estate agents and social media influencers. So we do have a niche navigation guide, and we will be sending out a link to all of you either later today or tomorrow so you can grab that guide. It has some other examples in there in addition to real estate agent and social media influencer. We'll talk about other ways to generate revenue for your firm using reasonable compensation, and reasonable compensation in and of itself is a niche for a lot of firms. And we'll talk a little bit more about some other ways to learn if you have other questions or looking for additional help or information on the topic of reasonable compensation. So when you're thinking about reasonable compensation, one of the first things we want to know is, what is it? How is it defined? So I'm just going to begin by using the IRS's definition. And the IRS defines reasonable compensation. It is the value that would ordinarily be paid for like services by like enterprises under like circumstances, and it must be both reasonable and for services rendered. Now imagine reading that definition off to your clients. It doesn't really hit home. It doesn't really do a great job of explaining what the concept of reasonable compensation is. So I like to redefine it in a couple of simpler terms: replacement cost and fair market value. So I would highly recommend you think about reasonable compensation in one of these 2 ways. Plus, it's much easier to explain it to your client these ways. So replacement cost. As an S Corp owner, if or any business owner, if you had to step out of your company for any reason and bring somebody else in, a third party, to come in and perform all the same duties and responsibilities that you're currently performing, what would that cost, right? That would be your replacement cost. So as a business owner, if I stepped out of my company, I went into my community, I hired somebody to come in and perform all the same duties and responsibilities that I'm currently performing, what would I have to pay that person? The flip side of that coin is fair market value. As a business owner, if I were to shut down my company and I was able to find another company in my community close by, and they would hire me to perform the same duties and responsibilities that I was performing at my company, what would that company pay me? And so these are two simpler ways for us to think about reasonable compensation. It's much simpler when we're explaining it to our clients as well. So one of the biggest challenges in reasonable compensation is helping accountants separate fact from myth when it comes to the topic of reasonable compensation. So I'm going to call this our first not a polling question. This is not a polling question coming up on your screen. I just want to give you guys something to think about when it comes to fact or myth. When you're looking at this list, which of these methods are recognized by the IRS as methods for determining reasonable compensation? Again, nothing to answer, not a polling question. Does the IRS recognize an industry rule where you would set wages as a percentage of sales or revenue based on some industry or based on some other industry standard? Does the IRS recognize what's quote unquote called the 50-50 rule or 60-40, something like that, where you would take total distributions and you would split them half and half between wages and distributions? They recognize any kind of a safe harbor where you would set wages at the Social Security maximum? Do they recognize all of these or do they recognize none of these? So RC Reports, we are a education forward company. We do a tremendous amount of education on this topic. And so far this year, we've asked somewhere in the neighborhood of, I want to say 70 or 80,000 advisors this question. So the correct answer to this question is E, none of the above. However, when you're trying to separate fact from myth, so far when we've asked this question, about 75% of the folks who answer this question will answer A, B, C, or D. This is a tremendously misunderstood area that has a lot of misinformation. It's misinformation that's passed down from one accountant to another. It's on the internet, etc. But when it comes to how you actually determine reasonable compensation, the IRS and the courts have put together a tremendous amount of information on how you actually determine reasonable compensation. And so that's what we're going to slide into next, is we're going to talk about how you actually go about determining reasonable compensation. Before we do that, we will get into our actual first polling question for today. Gary will have that up on your screen here in just a second. So Gary will leave this poll open for, I would estimate, probably for about a minute or so. And once that polling question comes down, we'll move into some other topics. In the meantime, I am going to just quickly scan our Q&A panel, see if there's any questions I can answer before we close down the poll.
Yeah, and just as a reminder, you do need to participate in 3 out of the 4 polls in order to earn that CPE. So if you need the CPE, go ahead and answer this one. We're going to be closing it out in about 5 more seconds. 3, 2, and 1. Thank you.
Perfect. Thank you, Gary. So the IRS recognizes 3 different approaches for determining reasonable compensation. But most of this information that we're relying to determine reasonable compensation really hasn't come out and really been well presented, well educated to accountants until about 2010, when that information started trickling out. The information we're going to look at now didn't come out till around 2014 or 2015. So one of the reasons there's so many myths in the field of reasonable compensation is prior to that, there wasn't very much good information out there. And so in that void, a lot of rules of thumb and other ways of determining reasonable compensation were put out there. But now we have much better information. And the information we're going to look at right now comes to us through an internal job aid that was put together by the IRS, and it was eventually released to the public. And in this job aid, they outline 3 different approaches for how one might determine reasonable compensation. And in the job aid, they compare the 3 different methods for determining reasonable compensation to the ways a real estate appraiser would value real estate. And I really like those comparisons because I found over the years it really helps advisors remember or help them choose which approach for determining reasonable compensation would actually fit their client's scenario best. So when you're talking about the cost approach, if we were to put on our real estate appraiser hat, this would be how we would price or value a new home. We would start with a set of blueprints. We'd do a takeoff of all the different materials and labor that is needed, and we'd add it all back up together, and we'd come up with a cost to build that home. Also known as the many hats approach, the cost approach for determining reasonable compensation is very similar. It takes into consideration all the tasks the business owner provides to their company, such as administration, accounting, marketing, purchasing, etc. It then breaks that time spent by the owner down into the various tasks that are performed. Wage levels are assigned for each task based on the owner's proficiency or skill level. And then it's added back together to obtain that hypothetical replacement cost for the owner using comparability data. So when we're talking about separating fact from myth and determining reasonable compensation, almost all reasonable compensation, overwhelmingly, is determined now using comparability data. What would somebody else being hired to do the same thing get paid for the different duties and responsibilities that the business owner is performing? And the comparability data set that we're typically looking for when you're talking about the cost approach or the many hats approach is what's known as cross-industry wage data, because you are pulling occupations from all different types of occupations because the business owner is wearing many different hats. When would you use the cost approach? You typically use the cost approach for what we think about as small or micro-sized businesses, right? These are small businesses where the owner is performing multiple duties and responsibilities and they're wearing multiple hats. So when we talk about niches, we're going to get into a couple here in a few minutes, but as we run through these approaches, I also want to give you a glimpse at another niche, which is tradespeople. And so this is Scott Stone. He's early in his career. He has a concrete business. He's wearing multiple hats for his company. So if we were to survey Scott and find out all the different hats he's wearing for his company, and they're on your screen now, we can use that information to build a cost approach reasonable compensation figure for Scott. We would take that information at RC Reports, we feed that information into our platform, and it will deliver a reasonable compensation report or study for Scott. So in this scenario, we're going to come up with a replacement cost, right? Kind of our alternate definition of just under $69,000 for Scott using that multiple hats approach. And you'll see on the right-hand side of your screen, all the different hats that Scott's wearing for his business. And they're blended together to create that hypothetical replacement cost for Scott. The next common approach used for determining reasonable compensation is called the market approach. And if we're back to being a real estate agent This is how we might look at determining reasonable compensation in tract neighborhoods, where the neighborhoods we're looking at are all different, but the homes in them are quite similar. So as a real estate appraiser, we'd go into that neighborhood, we'd look for homes that have sold recently with roughly the same size and finishes. We'd make some adjustments up or down based on that information, and we would come up with a value for our subject property. Also known as the industry comparison approach, the market approach for determining reasonable compensation is quite similar. It determines reasonable compensation by looking at compensation of employees and businesses of similar size and from the same industry, right? That's going to be our same neighborhood. The market approach focuses strongly on the owner's business and the specific position being held by that owner. And that's typically a management or executive level position. And there's a real practical reason why I'll share with you here in just a minute. And so the approach then compares both the business owner and his position in that company to other companies in the same industry and of the same size, and it draws a conclusion for what reasonable compensation should be using, again, comparability data. In this scenario, however, the comparability data we use is very specific. It's what's known as industry-specific wage data. And the reason that we typically see this approach used for mainly management and executive level positions is because industry-specific wage data is incredibly difficult and rare to come by in quantities large enough to be credible. So that's the real practical reason why you would see that. When would you typically use the market approach? Well, when we're talking about closely held businesses or SMBs, it's going to be for what we think about as medium-sized businesses, right? So these are businesses that have typically grown up over time. They might have started out smaller and the owner was wearing multiple hats in the early years, but now the business has matured and the owner is now exclusively or predominantly in a management or executive level role. So we met Scott Stone a little earlier. He's in the concrete business. This is 20 years later. He's grown up, he's grown his business to the point where now he is exclusively in that executive or management level position. Some of the information on the screen is the information that RC Reports would gather to help come up with a market approach figure for Scott. In this scenario, we have him as a CEO. We'd feed that into RC Reports. And in this scenario, it would develop a market approach compensation figure for Scott. And at this level and this point in his career, we would recommend a compensation figure somewhere in the neighborhood of about $270,000. So I'm not going to spend a whole lot of time on the third approach because overwhelmingly, reasonable compensation is determined using either the cost or the market approach. And for most small businesses or smaller businesses, it's going to be the cost approach, or as the businesses grow, the market approach. But there is a third one. I do want to let you know it's out there because it is recognized by the IRS. It's called the income approach. So for putting our real estate appraiser hat back on, this is really how we think about commercial real estate, right? Where an investor may be curious what the market or cost approach is, but what are they really interested when it comes to commercial real estate? Their return on investment. How much money are they going to make if they buy that property? Also known as the independent investors test, the income approach follows that same line of thought, but it does differ significantly from the cost in the market because it does not use comparable wage data. It relies on a very simple formula that's put out by the IRS. It seeks to determine whether a hypothetical investor would be satisfied with their return on investment when looking at the financial performance of the business in conjunction with the compensation level of the owner. So Paul, if it's not hardly ever used, when would it be used? It's used in a couple of places. One is for outliers. These are folks that have a unique occupation. They have a unique occupation. We can't find comparability data. We can fall back on the income approach. More typically when it's used in the accounting industry is as a second opinion or test for litigation. It may back up one of your primary approaches, such as cost or market, or maybe you use it to discredit the other side's conclusions. So again, it doesn't come up that much, but it is good to know it's out there and what its uses are. So Scott Stone, this small case study we're doing, later in his career, he invented and patented, and this is actually based on somebody I know, real life case study. He invented and patented some processes and additives for concrete. And so when you're talking about coming up with a reasonable compensation figure for an inventor, there's just no data out there. It's just all over the place. It makes that particular use case a good candidate for the income approach. Income approach, if you ever heard simple isn't always easy, this is a good example. You only need 3 pieces of information. If you have those 3 pieces of information, you can come up with a income approach, reasonable compensation figure. You needed the fair market value of the company at the beginning of the year, the estimated increase over that year, and then what an independent investor would look like, or for a target return would look like for that investor. If you have those 3 pieces of information, you can build out a reasonable compensation figure using the income approach. But today, what we're going to talk about is the most common approach used when we're dealing with closely held businesses, and that's going to be the cost approach, where the owners are wearing multiple hats. And it's because they are doing so many different things for their company, right? They might be doing some admin work, HR, bookkeeping, in addition to what they do specifically to their trade. And so in the cost approach, what we want to do is break down or catalog all of those different hats that they're wearing, and then build it back up to come up with the most accurate reasonable compensation figure. And so that's where we're going to head next in a couple of different case studies. Before we do that, polling question number 2 is going to come up on your screen. And Gary's going to pop back up on here and remind you all that you need 3 or 4 of these polling questions to get full credit. While this polling question's up, I have a question from Cynthia. What if the business is operating at a loss or does not have enough money to pay what would be calculated as reasonable compensation? Great question, bar none. Probably the most common question we get. And it's a little bit more complicated than I can get into here, but we do have some other classes on that. The question doesn't revolve so much around profits or losses, but it revolves around distributions. Number 1 article on our website will go through that, Cynthia. Also, we have a very thorough class on this where we dive into that topic around profits, losses, loans, et cetera, and how it affects reasonable compensation. The short answer is, if the business owner isn't taking out any distributions, right, they're not profitable, then they're not required to pay reasonable compensation. Thanks for putting that poll up, Gary. It's down now, so let's go ahead and talk a little bit about niches. So a really good friend of mine has used this phrase. I don't know if he coined it or not, but I always give him credit for it. And he is very specialized in the compensation world, and he uses the phrase, the niches are in the riches, or the riches are in the niches, one way or the other, you get the point. But when you talk about niches in accounting, reasonable compensation is in of itself a niche. And then within that, your practice may specialize in other niches. And so we do have a niche navigation guide that has the 2 niches we're going to look at today, along with some others. And even if the niche you're in or thinking about getting into and specializing within your practice isn't included in there, the information gives you enough examples through enough different niches to get a really good idea of how you might do it within your own niche. So the first niche I want to look at today is real estate agents. A lot of accountants do specialize, and some of you may specialize in real estate or maybe thinking about it. So this will be a very special use case for that. So real estate agents are fairly unique in the world of employment, right? They're one of the few occupations that's specifically carved out in IRS regulations where a real estate brokerage can actually pay their agents via 1099. It don't have to be W-2. Well, how does that apply? What are you getting at, Paul? Well, we'll get there. But because they're getting paid typically via 1099 from their brokerage, doesn't mean that as an independent contractor, that they still may not want to set that business up as an S Corp for a number of different reasons. But the one we want to focus on today is for tax planning, possible tax savings. So it may be beneficial for a real estate agent to set their practice up as an S Corp to take advantage of some payroll tax savings. So running a report for them will also help them understand the difference between what they make overall as a in their business versus what they actually do for their business. And I think that'll become clear as kind of we run through this example. So if we're trying to come up with a reasonable compensation figure for a real estate agent, and this is one of our niches, first thing we need to do that is we need to drill down to the local area. Where are you actually performing those services? Because wages are very specific to location. So in RC reports, the three first pieces of information we want to gather out of an 8-step process go pretty quickly. We want to know what the location is. And so we're going to be doing this for Nikki for Boulder, Colorado. And then the next thing we want to know is how much time is dedicated to the business. So we get into this in our deeper dive on reasonable compensation that I mentioned a little earlier, but there's court cases that limit the upper end of hours for S Corp owners to 40. A lot of you that are self-employed are thinking 40, that's kind of low. That's kind of part-time for a lot of people that are self-employed, right? But we've got some great case law that supports that. So at RC Reports, we do set the upper limit, which is the industry standard for full-time employment, 40 hours a week, 52 weeks a year, at 40. But if you do work less than 40 hours, of course, you can take that number down anywhere to as little as 1 hour per week. Once we have those three first pieces of information, now what we really want to do is start getting into the different hats that a real estate agent might wear. So when you're thinking about different hats a real estate agent might wear, filing, right? There is a tremendous amount of files and paperwork that needs to be kept in order and be kept for certain lengths of time, depending on the state that you're in. There's market research, not necessarily for your clients, but also for yourself. How do you market yourself as a real estate agent, in addition to the things you would do specific for your clients as a real estate agent, right? Got to keep books. You've got a business. If you have a little bit bigger real estate practice, you may have some office management or some HR to do if you have some assistants working for you. So on your screen right now, we developed 8 different categories that most small business owners will perform these tasks in. They start at maintenance, administration, marketing, and they go all the way down through maintenance, and so, or through management. And so in here, you simply select the ones that your client does, or you have your clients select them. There's some different options in our software to do that. But my big tip in here is look at those descriptions. Not so much the title, and make sure the description fits for what the client is doing. Once we've run through what we call the standard tasks section of an interview, then we want to move into what does the real estate agent do specific to their business? Well, this is a pretty easy one. They're a real estate agent. You can pop in here, select real estate agent, and add it to their profile. And at this point in time, we've accounted for all the different hats that Nikki wears for their business. Once we have all the hats, then what we need to do is apportion out that time. How much time do they spend wearing each of those different hats? So in this example for Nick or for Nikki, we've got some time at administrative, management. My business is real estate agent, marketing, finances, bookkeeping. And we're going to apportion that time out. On the screen, once we've apportioned out 100% of that time, we have one step left. And for most business owners, this is a 15 to 20-minute process. For those of you that work in this niche, if you've done a few of these and you've gathered the information ahead of time for your client, this is about a 3-step process. About a 5-minute process. Last step, we need to know what that skill level or proficiency is for the different hats that the business owner wears, because this will affect the reasonable compensation figure. And we see this used in IRS criteria guidelines, also in court cases, right? Less experienced or less proficient people get paid less. Highly skilled or highly experienced people get paid more. My advice here, when you're using RC reports or doing it in any other way, is start at average and then go low or high if you have a reason to, right? So if you have somebody who's highly experienced, has won awards, or maybe has additional accreditations, that may be reasons to go above average or high. Reasons to go below average or low might be they're fairly new to the industry, they're inexperienced. In the real estate industry, you can get your hand slapped for doing something wrong. Maybe that happened, and so that'd be your reason for going below average. Once we have all that information in, we get a synopsis of all the different hats, the different proficiency levels, and RC reports will generate a reasonable compensation report or a reasonable compensation study. And it'll also show all the different hats that that business owner is wearing and how that figure was reached. So for this case, for Nikki, we're at just under $91,000, and that would be their replacement cost or their fair market value. If Nikki had to step out of her business, she would expect to pay somebody $91,000 to perform the same duties and responsibilities. If she were to leave and go work, quote unquote, for somebody else, she would expect to get paid roughly that $91,000 figure. Polling question number 3 coming your way, and then we're going to take a look at another example. And that should be up on your screen now. And we're pretty caught up on questions. So when this polling question closes down, we'll talk about some other niches.
Okay, and just a reminder for the CPE, you do have to participate in the polls. So we'll close this out in about 5 more seconds. 3, 2, and 1. Thank you.
Thanks, Gary. Q&A panel, Rachel just popped in. Rachel's been an RC Reports user forever, and she popped in to say hi. Rachel, super fun that you joined us today. Thanks for joining us. All right, let's talk about another niche. So this is a fairly new one, right? The rise of the social media influencer. It's a very new occupation, and it's an occupation that not is necessarily being done full time. This might be kind of a part-time opportunity or position for somebody. But we do have wage data for social media influencers on our platform. But even as just a social media as a single hat, it still might be more beneficial to go ahead and build out that multiple hats approach. But one of the other things that I want to point out, and this is another myth in reasonable compensation, especially as it applies to S corps, is that when you have a single shareholder S corp, and the shareholder or owner is providing only services, there's a myth out there that everything that the company makes, all the profits that are being taken out as a distribution, need to come out as reasonable compensation, because there's no way to break those two things apart. Well, I'm not going to get into the details of that today, but there are court cases that demonstrate that that's not the case. And so using those court cases and other information from the courts and the IRS, when you do have that scenario of a single shareholder S corp performing only services, you can determine what their replacement cost would be, and then help them take out what needs to be paid as reasonable compensation, and then the rest can come out as distributions. So in the case of a social media influencer, this is a really fascinating case study, because I've consulted on a number of these for our subscribers, is how little time is spent by a lot of social media professionals once they've gotten up and running. And because when you think about where the income is being generated, a lot of this is being generated via the internet, when the person putting the social media content out there isn't actually performing any service, right? This is the internet, quote unquote, working for you. So keep that in mind as we kind of go through this case study. And so in this case study, again, we want to start with location. All wages are best determined by location, where you're performing those. So again, we're going to go back to Boulder, Colorado. It's typically where I go to when I'm doing my examples. But now we're going to set hours, and we're setting hours for this person at 10. Right? So this person is only working 10 hours a week. Might be a part-time job, or they may be making good enough money where they don't need to work more than 10 hours a week. But regardless, we still need to figure out how they're spending those 10 hours. So unlike a real estate agent, there may be very few standard tasks that a social media influencer might perform, right? They've got their small business set up. They're either thinking about or already set up as an S corp. When we go through that list of standard tasks, maintenance, administration, all the way down through management, really the only one that we're seeing in this example is going to be bookkeeper. But on the other hand, when we're talking about tasks that this person is performing specific to their business, now we're going to have quite a few more. So let's say we want to start off with what they're thinking of themselves at, which is a social media influencer. Great, we've got that occupation at RC Reports. But what else are they doing? Well, there might be a lot of creation of content, writing social media posts, graphic designer, video editor, camera operator. These are all different components or different pieces of what a social media influencer may do. And there may be some others, or there might be some folks that don't do all of these things. But for this profile, we're going to include all of these different hats. And then we're going to go back into, once we have all the different hats selected, then we want to go back into that apportioning out, right? How are we spending our time wearing all those different hats? And again, we're apportioning it out by percentage, because at the end of the day, we're really only looking at 10 hours a week. And also in here, setting that skill level or proficiency. So we've set all those for this profile. That summary looks like this on the left, but on the right, we've only come up with a reasonable compensation figure of about $18,000 a year. Not a lot. Again, we're only working 10 hours a week. So what's interesting about this profile is that this person may be generating revenue less than $17,000 a year. In that case, it may not make sense for them to consider being an S Corp. They might be new at it. They might be doing it part-time. Let's flip the script a little bit. Let's say this person's been doing this for quite a while. They've built up a pretty good book of business, and the internet is really doing a tremendous job, a lot of the work and the revenue generation for them. They may be making $50, $60, $70, $80,000 a year. We've seen it. But to replace themselves, to create that social post or take those pictures, etc., it just doesn't take that much time. And so this is, like I said, this has been a real fascinating occupation for me as I've consulted on a few of these, to see just how that, and we get into this in our other courses, as far as, revenue, making sure you pay yourself for the things you do that generate revenue, but also for the other things that don't. But you don't need to pay yourself for the other income producing employees for what the work they're doing, or for the machinery, in this case, the internet, that's producing that for you. So we've taken a look at a couple of profiles today, some niches that maybe you want to consider. Riches are in the niches. I had heard from Gary a little earlier, somebody had done a presentation on crypto. There's data in here, depending on what they're doing in crypto. You could come up with a profile for somebody who's working in cryptocurrency. I haven't done one, but I do know from spending enough time in our system that we have the different hats in there to build out that profile. So the niche navigation guide that we'll send you a link to either later today or tomorrow, in addition to having social media influencer and real estate agent in it, we have a couple others in there that you might want to take a look at, or as some niches to consider, or even use it as kind of a backdrop to some of the niches you may want to consider getting into within your practice. One is cannabis. More states have it than don't now. It's kind of past that tipping point. So we do have a case study in there on somebody who owns a business and is working in the cannabis industry. And then we did another one, and I just didn't think we were going to have time to get into it today, so I didn't include it in the presentation, for gig workers. And this is another one that fascinates me because it's another fairly new occupation. And that gig worker example runs through somebody who might be working on, maybe a handful of different apps, Uber and Lyft, right? They might be working as a personal shopper, or a Grubhub delivery person, right? And so they also have technology doing a lot of the heavy lifting for them, helping them find that business. And so they may want to take all of those different revenue streams and bring them into a business entity like an S Corp. And so we have that one built in there for you as well. So besides talking about reasonable compensation and these niches, a few other things I'd like you to think about when you're thinking about reasonable compensation, just as a general overall niche for your business. When you're thinking about that niche in reasonable compensation, there's a number of other areas where reasonable compensation applies to closely held businesses. And it really is part of their entire life cycle, if you think about it that way. So it is generally first looked at when the business is considering entity choice, right? Reasonable compensation is a huge factor from a tax standpoint in determining whether or not it makes sense from a tax perspective to become an S Corp. Other parts in the life cycle, as a business owner, you might decide to either be buying or selling a business. normalizing owners' compensation as a part of that process. It comes into retirement planning. One of the things that a lot of business owners neglect to think about, and that we really hope that you all talk to your clients about when it comes to reasonable compensation and S Corps, is understanding that when you set your reasonable compensation figure unreasonably low, you're also cutting back on your Social Security benefits. For that social media influencer, that might be a conversation to have with that person. What if that person's goals were to build up as much Social Security benefits as they can? Well, you might not want to advise them to be an S Corp. You might want to have them stay more of a Schedule C, where they would pay employment taxes on everything. Those of you that get into some other areas, valuations of estates or taxation of estates, reasonable compensation almost always comes into that if there's a small business or any business that's involved in that process. So if the riches are in the niches, how do you charge for reasonable compensation consulting? Well, there's a number of ways that firms do this. The two most common, if you're doing it from strictly a compliance standpoint, not what we're really talking about today, but from a strictly compliance standpoint, most people just add a straight up additional fee to their 1120S package. In our surveys, that number is about $200 to $300 in addition onto that 1120S package. But most advisors, and I would assume most of the advisors that are here today are looking at adding this as a revenue stream for their own company. So there's a number of ways to do that. You can charge on a one-off basis for a report. Typically, that's a $400 to $500 a report is what we see charged. But we have an entity planning tool that you can use. And as part of that, you can build in a whole different range of other services and products when you're doing an analysis on entity planning, which is the last bullet point on there. And so that can give you some opportunities to build in payroll, for instance, since they're maybe going from a Schedule C to an S Corp, maybe they don't have payroll set up. It's a chance for you to offer that service. It's also a chance for you to talk to them about doing their 1120S for them. They're not currently an S Corp, and any other fees and consulting that you may want to build into that. So having that discussion with your business owner at that entity planning stage, and in my opinion, is one of the best places to really start discussions about other services that your company can provide, and also help them through that life cycle of their business. I'm going to take a look. We've had a couple of questions come in, but while I'm looking at those, we're going to have Gary bring up our last question, polling question for today. I have a fairly lengthy question from David. David, I might have you just email that question in. I think it's a little bit more than we can get into. Today, it's pretty specific, but either myself or our VP of Education, Jack Selesky, be happy to help you out with that question. And again, this is the last of our four polling questions. If you've answered 3 of the 4 polling questions, you've been on with us for 50 minutes, and we're just coming up on that 50-minute time frame here. You will qualify for CPE for today.
All right, and we'll go ahead and wrap this up in a couple more seconds. 3, 2, and 1. Thank you.
Thank you, Gary. So what's next? Well, we are an education-first company. We do a tremendous amount of education on the topic of reasonable compensation. We barely touched the surface of the topic today. We have a 2-hour in-depth session on reasonable comp for S Corps. It is complimentary. We run it on a number of different platforms. It is an undergraduate and master's degree in reasonable compensation, all wrapped up in a 2-hour session. If you haven't taken it or you'd like to learn more, I'd highly recommend that. We also have some other specialized classes I would point you toward if you're interested. We have a 1 hour on reasonable comp and 199A. It's an entire topic all up on into itself, as well as one on reasonable compensation on entity planning. For those of you who took this, I think that's a natural next class for you to take as well. If you are interested in learning more about who we are at RC Reports, I highly recommend see us in action. I've shown you a little bit today. I've kind of scraped the surface. We have an unbelievable demo team as part of our overall team. They would be happy to spend roughly 30 minutes with you and kind of walk through how RC Reports works in real time and answer some of your very specific questions. With that, I'm going to see if there's any other questions in the Q&A panel. And if there's not, Gary, is there anything else you'd like me to go over or talk about with the folks today?
I'm going to repost the slide deck into the chat. Somebody requested that. And then one question for you is, and this might be for me personally more than anything, but just because I find it to be a fascinating topic, but what's I guess, is there a 1, 2, 3 checklist? Like if a practitioner is looking at their book of business and kind of what's the number 1, 2, and 3 things that they need to look at to help narrow down who to speak with about this might be my first question.
Yeah, so first and foremost, when you're looking at your book of business, look at your Schedule Cs, and this is a great time to do that. Look at your Schedule Cs and take a look at where their revenue is for the year, and what might be considered, if they were an S Corp, what their distribution would be, or their net profit, because that's my favorite place to consult on reasonable compensation. It is an important compliance issue. Don't get me wrong, the IRS is turning up the heat on this, but when you're talking about helping your clients, especially from a tax planning standpoint, look at those Schedule Cs, and then if you're using RC Reports, we have an entity planning tool built in there. Run through that and show them or demonstrate to them what that tax savings might be. And again, talk through them all the different consequences, right? Because it does affect Social Security and some of those other things that we touched on. So that would be first. The next thing I would look at are my current S Corps, whose reasonable compensation was pulled out of thin air or seems unreasonably low. Preparer penalties have been handed out on this. If you guys are all familiar with Eric Green out there, he did a case study for us. It's on our website. You can read it. A preparer was hit with $130,000 of preparer penalties for his S Corp book of business. I won't get into the details of it, but you all have risk out there as well as your clients if reasonable compensation is challenged. So that second point is more for you guys to look at for risk for you and your clients. And then third is another planning opportunity for your clients. Maybe some of them are overpaying their reasonable compensation. Maybe they're using the Social Security maximum, something along those lines. Having an accurate compensation figure can give you a place to just have a discussion about whether that number is realistic or not. Maybe lowering it can also lower their payroll tax liability. And those are the 3 things I would look at.
Okay. And then do you have any, just before we wrap up, do you have any success stories that you could share?
So we do. We had RC Reports used in an audit earlier this year in a Florida case, another article on our website. And the business owner had absolutely no backup for the reasonable compensation figure. And so when the examiner said, hey, looks like your compensation, I think they'd set it at, I'm doing this from memory now, at I think I want to say like $45,000. And the examiner said, where'd you get that number? And the business owner didn't know. The tax advisor was new. The business owner had switched, so that tax advisor didn't know. And so the examiner said, okay, well, I don't think that's reasonable. I'm changing it to $67,000. And that meant about $10,000 of tax penalty and interest to this small business owner. She ran a nail salon. The tax advisor and EA uses RC reports. One of the things we offer is audit and litigation support to our subscribers. She reached out to us. We talked her through that scenario, and we said, hey, let's get the working papers from the examiner, and let's take a look at a report run by RC Reports. The report run by us, oddly enough, and I've seen reports driven up or down to meet a goal. This was not the case. This was a really fair look at this business owner. It came to within like $1,000 of what they'd actually paid themselves. So long story short, after both parties looked at, the examiner looked at RC Reports and the EA looked at the examiner's working papers, they really agreed on almost everything except the percentage of time that the business owner spent doing different things. Our report plus some other documentation that the business owner and the EA were able to provide demonstrated to the examiner that, hey, look, the report from RC Reports is an accurate reflection of what they do. And ultimately, the examiner agreed and they got a no change notice. So that was a huge success story. The negative of that is the business owner still had to go through quite a bit of pain and suffering to get there. And so there's a couple of pieces of advice I would leave you with on the compliance side. One is the first with a fact-based figure wins. In this case, they had no backup for that figure. And second, if it's not documented, it's not done. It is likely that the IRS is going to be turning up the heat on this issue for a number of different reasons. The biggest one most of you already know about, which is their additional funding, but also because it's just been a compliance thorn in their side for a long time. So another quick success story, if you have just another second, and this is from Rachel, who pinged in a little earlier, and I will read this verbatim. I had a audit success a few years ago with RC Reports, and I'm in the middle of a C Corp audit now. Hey, Rachel, you're gonna have to reach out to me and let me know more about that one. We don't do as many Cs, so I'm fascinated. Used the report to show owner wages that were split with another S Corp that they own. So fantastic, Rachel. Love those use cases. We put them up on our site and keep track of them. It does help anytime any of you go in to have these other cases have been already decided and seen out there. So, but again, the riches are in the niches, folks. Not a lot of folks doing reasonable compensation or specializing in those niches. And so I hope this session was able to help maybe bring some of that stuff, some of those opportunities into focus.
Great. Well, thank you, Paul. Certainly appreciate your time and sharing the information that you have there. I just, there was a statement in the chat that I sent over to you as well with an email address. So we certainly appreciate your time, appreciate your support of the Future Forward Summit. And just as a reminder, we are kicking off our Top 100 Pro Advisors Awards program sometime in the next week or so. So keep an eye out for that information on Insightful Accountant, our newsletter, as well as on our social media channels. So hope everyone has a wonderful night, and we'll see, I'm sure we'll see some of you in QuickBooks Connect in Las Vegas next week.